in the webinar, we will focus only on the two main parts, which most of the time, this is 99% of the questions that we receive in our meetings, is AI in a bubble, and should we invest in the US stock markets in the current scenario? So these two questions, we thought that it overshadows everything else. No matter how good the portfolio is, or no matter what we say about the portfolio or stocks, this question is always there in the back of the minds of our investors. And so whatever we say doesn't potentially go through, and people are not willing to listen. So we said, today we will focus exclusively on these two questions, and we'll get into the depth of it as much as you want. If you have any questions, we'll get into more depth. But let's start with the first point: is AI in a bubble? A large part of the US portfolio that we have is exposed to the AI theme, and it's about 30 to 40% of our portfolio right now. So it's very important for you to understand that AI is not in a bubble. When people talk about a bubble or overvaluation, they are talking about 15 to 20 stocks, literally 20 stocks that you can pinpoint in the market that are overvalued. Out of those 20 overvaluation, 10 of them could be in a bubble. So, for example, take Palantir. It trades at more than 100 times sales. So there you can say, yes, it is overvalued. You could call it's in a bubble territory, but there aren't many such stocks, especially in our universe that we cover. We don't cover the small and micro caps or mid caps. We don't care about them. We primarily invest in large caps. So if you look at the large cap universe, there aren't many such stocks. And we will go through the valuation metrics for the entire sector as well as a few individual stocks to show you why those 20 stocks that the media talks about are overvalued and could be in a bubble territory. But the other hundreds or thousands of stocks that we follow and invest in, they are nowhere close to a bubble territory, and we should happily invest in them. So that's what we'll discuss in the valuation part. The second part we'll discuss is the massive cash flows you are seeing from these large caps. So typically when you have such massive cash flows, bubbles do not happen, because cash flow is a very strong fundamental factor that supports the stock prices. So you cannot call it a bubble. We'll do some comparison with the dot-com era and how it is incorrect, and why capex is not a concern for these businesses. So let's go through that one at a time and address them head on. So yeah, so this is the first one where we are trying to see if the whole sector is in a bubble, and we are trying to compare it to some bubble time valuation metrics from the tech bubble in the year 2000. At the bottom on the right hand side, you will see, and the purple column is the one which is the valuation related metric, which is PE ratios, 24-month forward PE ratio. So if you will see, currently the PE ratios are all in the 20s and 30s range, right? So 20s and 13s range for an aggregate of 23.9. So I say, let's say round it off to 24. It is nowhere close to the aggregate PE ratio in the bubble era, which was 52. So close to double. And individually, you see some of them are above 100. They were above 50, 60 PE ratios. Whereas currently, they're all in the 20s range. So it's far away from a bubble. These stocks need to at least double or triple over the next few years to get into bubble territory without the earnings increasing. So always remember, PE ratio is a ratio of price and earnings. If earnings increase, then this PE ratio will not increase. So without any further earnings increases, the stock prices have to double at least to get to bubble territory of the year 2000, which so far doesn't seem to be the case. So we firmly believe, from a valuation perspective, these stocks are nowhere close to a bubble territory. Another important indicator, Berkshire Hathaway bought about $5 billion worth of Google shares in the last 3 to 4 months. So, and this was a new position. This was not a position that they held like 5 years back or 3 years back, and they just added to it. No. Berkshire Hathaway, as we all know it, it is Warren Buffett's investment company, and they initiated a new position in Google with a total investment of about $5 billion. And they are a value investor, and they are not pressured by anybody. They really don't care about what AI is doing or what the world is doing. They focus very much on the valuation of a company. So when they are investing, one of the marquee value investors in the world is putting 5 billion of their money in a company which is at the top of the AI table. For people talking about AI bubble and all that, it clearly says that the entire sector is not in bubble territory. So definitely we do feel that a lot of these stocks are very much worth investing, and we continue to invest in all of these stocks. Moreover, why this is happening is because AI, when it started, it was considered as a single sector because there were probably 30 stocks or 40 stocks that were benefiting from the AI theme. Now there are hundreds of stocks that are benefiting. So now you can differentiate between the semiconductor players to semiconductor manufacturers to chip designers to software players to middleware, all the way to consumer applications. So the entire ecosystem is now well developed, and you can differentiate between different players within the AI ecosystem. And that's why when we say 20 of those stocks, that means some parts of that ecosystem are overvalued, but the rest of them are not overvalued. So we typically, when we see this, we move away from the overvalued part of the ecosystem to the undervalued part of the ecosystem. So some semiconductor stocks, maybe they are overvalued, but and that doesn't include Nvidia, by the way. As you can see in this chart, on the top, the third stock from the top is Nvidia, and it's trading at only 24 times PE multiple. And so that's why Nvidia, even though it's a semiconductor stock and it's one of the largest ones in the AI space, in fact, largest in the world, it is not in the bubble territory from a valuation perspective. So we are pretty happy with that. There's no issue with Nvidia per se. And so this further goes on to say that within AI, there are pockets that are expensive, there are pockets that are cheaper. The whole space is not expensive. So we cannot stress enough that you should not be worried about a AI bubble or a valuation bubble in the AI space. If you are worried about it right now, you will probably miss the next 2 or 3 years of gains and stock returns, which we are expecting based on their current valuations and current earnings. So don't worry about the AI bubble from a valuation perspective. Absolutely nothing to worry about it. Moving on to the next slide. Stock bubbles don't look cash rich. What we are trying to say over here is, what is the cash position of these top AI stocks, the ones that we discussed in the previous slide? You will see starting from $102 billion of a cash position on their balance sheet. This is net of any debt, to $41 billion at the lower end, which is with Tesla. So if you have such huge cash positions, you are not even talking about leverage at this point. There is a long pathway for you to use this cash. And plus, they generate similar amounts of cash. Each one of these companies, they generate $75 to $80 billion of cash every year. So when we moved from December to Jan of 2026, for all of these companies, they added another, let's say, $70 to $80 billion of cash last year in 2025. So when they are spending cash, it doesn't matter a whole lot because they are generating it at such a fast pace too. So these cash positions are a further buffer that even though they are doing capex, it does not hurt them at all in terms of their cash position from a balance sheet perspective. So when you have such huge cash positions, it is highly unlikely that you can call them in a bubble territory. Typically, in a bubble era, it is exactly the opposite. Companies are over-levered, stock prices are massively overvalued, and when you are over-levered, even a small mistake or a small change in the macroeconomic conditions causes the stock prices to crash significantly, and that is what is the definition of a bubble. Right now, we are in the exact reverse position where the valuations are decent, as we discussed in the last slide, and these companies have massive cash positions. So then getting into trouble over the next 1 or 2 years, is the probability of that happening is fairly low. Let's move on to the next slide. So even then, we do get questions about comparison with the dot-com boom for between the AI stocks and the and the characteristics of the dot-com boom. So the middle column actually in your table you see is the characteristics of the dot-com boom from the early 2000s. And then the second, the last one, the third column that you see on the right-hand side in that chart is the characteristics of the current AI-related companies. So the first part, the technology, let's get it out of the way. The dot-com boom was all about fiber optics, the physical connection that provides internet access to everybody in America as well as the rest of the world. And there was a massive overbuild in it. We knew companies like Level 3, WorldCom, these companies went bust because they overbuilt massively, expecting the demand to come. Their utilization rate, as you can see from the third row from the top, was 7% in those days. So 7% is a fairly low utilization rate. So there was massive overbuild and overcapacity that was being built in the dot-com era by those companies. Today, that is not the scenario. We are still hardware constrained. Today, if I want to go ahead and order an NVIDIA GPU, there is a 3-month waiting list. That does not say that there is an oversupply. Actually, there is a bottleneck right now. There is no question of oversupply. The utilization rates are 80% plus for all the hardware. And that includes hardware that was bought 5 years back also, which may not be used so much because they are now mostly not that useful because they are older hardware. So even then, for the entire industry, the utilization is above 80%, which does not get even close to the 7% utilization rate that we saw in the early 2000s. And so that's why, from a capacity, demand, supply perspective, there is no comparison between the dot-com boom and the current AI boom that we are seeing. We are far away from that. Maybe overcapacity and overbuilding will happen 3 to 4 years into the future, but right now we are not even close to that, right? And so I think that debunks another myth. So first we discussed valuation. The second we discussed cash positions. Third, we are talking about demand and supply. None of these actually support any worries about a AI bubble or any issues in the AI space. That brings us to another question, which is margins and the capex that they are doing. So anytime a company is spending on either on R&D or on infrastructure, you have to be worried. Are they generating margins out of that, or this spend is going to be useless and they are not going to generate margins and earnings out of that? So if you see the chart below, this is the cloud segment of Google. This is not entire Google, just the cloud segment, which is the AI infrastructure segment of Google. This segment, their margin from the first quarter when AI was introduced, that was March of 31. At that time, for Google's AI cloud infrastructure segment, their EBIT margins were 2.6%. Right now, they are 23.7% in the September quarter. So you can imagine what a huge jump they have had. They have had almost a 20 percentage point jump in margins. So now if you were running this company, would you like to spend more on such business where your margins are growing day and night? Absolutely yes. And that's what they're doing. So when Google says that they are spending on AI, or when Microsoft for the same business, Microsoft's that segment margins are 43%. So you can imagine Google is at 23.7%. They still have the possibility of going all the way to 43%. Everybody doesn't maintain the same margin. So Google could get to 40, Google could get to 50. We don't know that. But the trend is clear that it is expected to grow. And we already have examples where Microsoft similar business is doing 43% EBIT margins. When you are doing such EBIT margins, there is no chance practically zero chance of a bubble because these are huge revenues. So you are not talking about revenues of a few 100 crores or 1,000 crores where you are making such huge margins. These margins are or on a revenue of 80 billion that we are expecting for that segment for Google for CY26. So on an 80 billion, EBIT margins being close to 23% means you are generating about $19 billion worth of cash from that business alone on an annual basis. So this doesn't worry us at all. In fact, we are quite bullish on a lot of these stocks in this sector because of such massive cash margins, EBIT margins, and the growth of that. If it were a bubble, you would see the exact opposite. This chart would be 23% when it started, and by now it should go down to 2-3%. Then it could be a bubble. This is the exact opposite. So that's why we are saying that we are not even close to a bubble, because the things that we are seeing are the exact opposite of a bubble, not even leading to a bubble. So from a fundamentals perspective, we don't believe a lot of these companies are anywhere close to a bubble. Again, margins are increasing and increasing massively. That is not a sign of a bubble. So I think this ends our discussion about whether AI is in a bubble or not. Now we'll move on to the general US economy